What I have for you this week is a rather interesting case with both interesting technical and political aspects. Now, this is probably going to be one of the more controversial videos that I make, and that is simply because I don't have a lot of sympathy for the taxpayer, but allow me to explain why. Before we start talking about this case, we need to talk about the US CFC rules, and we need to talk about what an FBCSI is, or a foreign-based company's sales income. Right, so Article 952 of the Internal Revenue Code is the US CFC rules, and it says, for the purposes of this subpart, the term subpart F income means, in the case of any controlled foreign corporation, the sum of a whole list of things, including the foreign-based company income as determined by 954. And 954 then says, for the purpose of 952(a)(2), the term foreign-based company income means for any taxable year the sum of foreign personal holding company and then the foreign-based company's sales income for the taxable year, and a number of other things. And then letter D of 954 describes what foreign-based company sales income is, and it says in general, for the purpose of subsection A2, the term foreign-based company sales incomes means income derived in connection with the purchase of personal property from a related person and its sale to any person. Right? Let's just stop there. Where letter A, the property which is purchased, is manufactured, produced, grown, or extracted outside the country under the laws of which the controlled foreign corporation is organized. So what this legislation tried to hit was it said that when you, for instance, have a manufacturing company, let's say in Mexico, right, and that company sells stuff to an intermediate company, let's say in Luxembourg, which then on-sells that stuff to, let's say, the US, then that intermediate company will earn foreign-based company income. In other words, it will be CFC income. And the reason why they do it is because the tax rate in Mexico may, for instance, be 28%. So you make something for 10 and you sell it to the Luxembourg for 11, so you only make one profit. And then the tax rate effectively in Luxembourg might be close to 0. And then you sell it from Luxembourg to the US for, let's say, 99, and then the US sells it to its customers for 100, right? So the difference between 11 and 99 is then taxable in Luxembourg at 0%, and that must be taxed as CFC income because the US government doesn't want to wait until that profit gets distributed one day. That's the history of the US CFC rules. And now the question is, what happens then if you don't have a foreign subsidiary that makes stuff, but you have a foreign branch, right? And then they've got a letter 2 to 954D, and that says, for purposes of determining foreign-based company sales income, in situations in which the carrying on of activities by a controlled foreign corporation through a branch or similar establishment outside the country of incorporation of the controlled foreign corporation has substantially the same effect as if the branch were a wholly owned subsidiary, in other words, the situation we just discussed, deriving such income under regulations as prescribed by the Secretary, the income attributable to the carrying on of such activities of such branch shall be treated as income derived by a wholly owned subsidiaries of the controlled foreign corporation. So that throws you back into this thing of that you're a company in the middle buying from other companies, for instance from Mexico, and selling to other group companies, for instance your US parent. So this is the US CFC rules, right? And our case looks as follows. Pre-reorganization, Whirlpool Corp in the US owned Whirlpool Mex in Mexico. And Whirlpool Mex had two subsidiaries, Comercial, who was just a administrative company, and Industrias, which owned two factories and land and equipment, and it made a huge amount of washing machines and laundry machines or fridges, white goods in any case, every year, which it sold, I think in 2009, the court said, for something like $800 million in turnover. So this was your structure, and in Mexico you paid 28% tax, and in US you paid whatever the US tax rate was. But then there was a restructuring. So if we look at the left-hand side of the restructuring, you can see everything stayed as it is, but Whirlpool introduced Luxembourg and incorporated Whirlpool Luxembourg and Lux in Luxembourg. And Luxembourg incorporated Whirlpool Industrias Nacional, I believe was the name, in Mexico, and it had 1 FTE. To be clear, Luxembourg had 1 FTE. So Win concluded a Maquiladores agreement with Lux, and a Maquiladores agreement is in fact a contract manufacturing, toll manufacturing agreement in which Win agreed that it would make all these washing machines and white goods for Lux, and Lux then concluded a manufacturing and supply agreement with Whirlpool in which it said, we will take care and make all these things for you. Now, Lux had 1 FTE, Win had none, so who was doing all the work? That was very simple. Industria subcontracted its 3,000 or more than 3,000 employees to Win to do all the work. It sold all the manufacturing equipment and things like that to Win, and it leased its land and buildings to Win. So Win did everything through Industrias. And then Whirlpool checked the box on Win so that Win became a disregarded entity for US tax purposes, right? So this is how our structure looked post restructuring. Now let's just make a couple of points here. The first one is, if we look at this from a US tax point of view, Win doesn't exist because it's a disregarded entity, right? So it's treated as a permanent establishment of Lux in Mexico. And then second, instead of being a passive reseller, Lux seemed like an active production company with a production PE, because remember when we talked about the US CFC rules, we said if you have an intermediate company buying from one group company and selling to another, you're hit by CFC rules. But now, by checking the box on Win and making it the Luxembourg Mexican PE, that rule seems to fall away. And then you've got this paragraph 2 that we also looked at, but we will deal with that in more detail in a moment. That this was the aim of the Whirlpool restructuring, that it should look like this, and Luxembourg should now look like an active company. And then Whirlpool wanted Luxembourg to see Win as a PE. In other words, we've got a PE just like the US says, but it wanted Mexico not to see Luxembourg as having a PE, and it agreed that with the Mexican government. So the consequences of this structure was Mexico, there was no tax for Lux or Win because there was no PE, right? I mean, Win paid a cost plus 6, I believe, on its manufacturing for the FTEs, but nothing more than that. In Luxembourg, there was no tax because, opposite to Mexico, it said there is a PE in Mexico, and therefore there's nothing for us to tax because we only have 1 employee, remember. And then for the US, they wanted Luxembourg not to be a CFC because it is an active production company, right? This was the aim of the structure. The IRS did not agree with this. They made an assessment, I think, for $49 million in the end, as the profit of Luxembourg that wasn't taxed. They got hit by US CFC tax, and they went to court. So if we look at what the U.S. tax court said, the U.S. tax court, Whirlpool lost before the U.S. tax court, right? The U.S. tax court said, if we look at the petitioner's arguments, Whirlpool Luxembourg sales activities, petitioners first contend, in fact, that Whirlpool Luxembourg had no substance, which is right? Because Whirlpool Luxembourg had only 1 part-time employee, petitioners urge that the remainder performs no sales or purchasing activities, and hence that the manufacturing branch rule is inapplicable. In other words, we've got 1 half-time guy in Luxembourg, we've got 3,000 manufacturers in Mexico, therefore you can't say that we are a sales company, right? This argument, the tax court said, strikes us as facetious, and rightly so. The essence of petitioner's position under 954D1 is that Whirlpool Luxembourg was a real company engaged in real business activities. And when reorganizing its Mexican manufacturing operations in 2008, Whirlpool the taxpayer, chose its corporate structure. Under that structure, Whirlpool Luxembourg was the company that owned the products and sold the products. That being so, petitioners cannot plausibly contend that Whirlpool Luxembourg performed no sales activities. Right? Second argument of the taxpayer was that there is no difference in tax rate between Luxembourg and Mexico, right? The tax rate the official tax rate in Mexico was 28%. I believe it came down to 18 or 19% for maquiladores because of certain tax concessions. And in Luxembourg, the tax rate was around 28% as well. But the effective tax rate in Luxembourg was 0. So petitioners next contend that no tax rate disparity exists when we compare the actual and hypothetical rates between applicable to Luxembourg sales income. Petitioners assert that the effective Luxembourg tax rate should be 24.4% rather than 0, even though they didn't pay anything. And they assert that the hypothetical Mexican rate should be 0% rather than 28. Now, this is a jiggling of facts and fiction to an extent that the court just simply said, we do not follow what you say. They say the reality is the tax rate was 0%. Whirlpool Luxembourg paid no tax to Mexico on the sales income because it was deemed under the Maquiladora decree to have no PE in Mexico, right? So the sales income wasn't taxed there. And Whirlpool Luxembourg paid no tax in Luxembourg on the sales income because it was deemed under Luxembourg law to have a PE in Mexico. And this is specifically what was requested by Whirlpool from the separate tax authorities. And then there is the same country exception. And now we talked about the CFC rules, and we said that this intermediate company should be taxed because it is a passive income buying from one and selling to the other. But there was also an exception under that, and that was if the same company was actually making stuff in the same country, then you can't call it a passive company because it was making stuff and selling it, right? It might buy the raw materials for the stuff that it makes from other related parties, but it still is an active company making stuff, right? And so Whirlpool said, well, we also have an active company here, so we apply the same country exception. Petitioners contend that our analysis should center on Win, because remember they said Luxembourg was nothing, and that the sale of the products manufactured by Win fit within the same country exception. This exception applies where property is manufactured in the countries under the law of which the CFC, which purchases and sells the property, is created or organized. And the court says this is just nonsense. We don't look at Win, we look at Lux, because that is the real company in question here, right? And then we come to pretty much the rest of this case, and that is validity of regulations. And Whirlpool went to extraordinary lengths on this argument, right? Before the tax court, they argued as an alternative to the arguments addressed above, petitioners contend that the regulations are invalid as applied to the structure Whirlpool created. In petitioners' view, section 954D2, the one that we read in the beginning, applies only in situations where a CFC conducts manufacturing activities and has a sales branch, but not to the converse situation where the CFC conducts sales activities and has a manufacturing branch. To me, that seems like nonsense, and the tax court agreed. The court said, regardless of whether section 954D2 is viewed as ambiguous or silent on the manufacturing branch issue, we conclude that the Secretary's manufacturing branch regulations are a reasonable interpretation of the statute, in other words, of 954. The Secretary was authorized to prescribe regulations under 954D2 because the manufacturing branch regulations are fully consistent with Congress's intent as expressed in the legislative history. We cannot find those regulations to be arbitrary, capricious, or manifestly contrary to the statute. We accordingly reject petitioner's challenge on the regulations. And Whirlpool was very upset and went to the Tax Court of Appeal, and the Tax Court of Appeal basically followed the U.S. Court of Appeal followed the tax court. They said Whirlpool created another corporation, this time under Mexican law, called Win. We already looked at that, which was wholly owned by Lux. Win had 0 employees. Lux had 1 who worked part-time in Luxembourg. Yet on paper, Whirlpool's manufacturing operations in Mexico were conducted entirely by Win and Lux. And then they say, if we look at the before and after situations, on the ground in Mexico, nothing changed. The same employers, Industrias and Comercial, paid the same employees to make the same appliances in the same factories just as before, and the Court of Appeal rejected this appeal, right? And then it would be fair to say that all hell broke loose, because